Hi, everybody. Welcome to episode 2. Thanks for joining. I appreciate everybody joining, subscribing to my page. Continue to share. Continue to let your friends know about the page. That way, we can all learn. Tell them to drop comments. You can drop comments. Anything that you want to learn about in next episodes or future episodes, just drop a comment and I'll definitely go over it in the episode. But like I said, thank you all for joining. Thank you all for coming, tuning in for episode 2. I definitely, plan on doing this every Sunday if I can, just to get something out there, just to get something, in the week started. So in this episode 2, I wanted to talk about option trading. I had a family member reach out to me and inquire about that, about the quick bang for my buck that I was referring to in my last video. And I was referring, when I was saying quick bang for your buck, I was referring to option trading. And the whole thing with option trading is, I say quick bang for your buck, but that's exactly what it is. I mean, you buy a contract in something and the next day the stock goes up and you make a lot more than versus buying just one share. So just to go in on option trading, what option trading is, you buy a contract. You buy a contract of a stock. So for this video, I'm going to refer to this stock as stock X. So you buy one contract of stock X, you now own 100 shares of stock X. And that's the cool thing about option trading. When you buy a contract, you own 100 shares. The more shares you own, the more money you can make. That's the whole thing regarding stock. The more shares that you own of anything, the more you can make when the price goes up. So that's the cool thing about buying contracts. When you buy one contract, you own 100 shares versus you can buy 100 shares outright, but it's going to cost you a lot more. So to dive in on that more, like I said, we're referring to stock X in this video. So let's say we buy stock X. Stock X is worth $4 a share right now, right? You buy 100 shares of stock X, you now spend $400 if you bought it outright. You buy a contract in stock X, you have different prices of that. And what I'm referring to is, you can buy a contract in stock X. Stock X is worth $4. You buy the contract, you now only pay $23 for that contract. You own 100 shares still, but you paid a lot less than when you would bought that stock X outright. And that's the cool thing when you're trading options. It's usually a lot cheaper to buy contracts than it is to buy the share outright. So let's say, for this video purposes, we're buying stock X and we buy stock X and it's going to expire in March. The whole thing regarding option trading versus buying stocks outright is time. Time is a big thing when you're doing option trading. You want to focus on your time decay, and you want to focus on your timing of getting in and getting out of that contract. So to dive a little bit more in that is, when you buy a contract, you have a strike price that you set, and the strike price is the price that you feel that stock is going to reach. So I bought stock X at $4 and my strike price is at $8. And I bought my contract out 2 months. So now I set it to expire in March. So now what I'm saying is, I bought this contract, it's set to expire in March, and the strike price is $8. I'm saying that this stock X, is going to go from $4 to $8 by March. And I'm saying it's going to reach that. And then once it reaches that, that's when my contract that I bought for $23 is now worth a lot more. So to dive into that more, I bought this contract now for stock X for $23 in January. I set to expire in March, and let's say February comes, right? February comes, stock X goes from $4 to $7. Now my contract that I bought for $23 is worth, let's say, $100, right? Now I'm up positive $77. I'm positive. And now the way that I'm looking at it is, okay, it's set to expire in March. What do I do? Do I stay in it? I'm positive profit $77, or do I get out of it now and just pretty much take my profits and run, right? What I advise people is, you always want to get out of that contract at least a week or 2 before it's set to expire. And the reason why is, time decay plays a big factor when you're buying contracts. So the reason why you buy that contract 2 months out is so time decay isn't affecting your contract so much. And that's a big thing, because let's say you bought that contract, you bought it in January and you set it to expire 2 weeks later. Now time decay plays a major role in your contract going up or going down. And what I mean by that is, if you bought it at $4, stock X is worth $4, and now it jumps to $5, your contract is going to jump up price significantly. Now, if it declines, it goes from $4 and goes down to $3. Now your contract is going to drop significantly. But if you bought that contract in January and you set it to expire in March, and the first 2 weeks it drops, let's say from $4 to $2, you're not losing as much money. You might lose $10, and now your contract is worth 13 versus 23. You get what I'm saying? Versus if you bought it and it set to expire in 2 weeks and your contract jumped $2, now your contract is probably worth $5. So you lose a lot more money, and that is because time decay. And a lot of people don't talk about that when you're buying options. Time decay is major, and that's why I say you want to buy something 2 months out, because you want to avoid that as much as you can. You don't really want to play with time decay, and you definitely want to get out of that contract before time decay starts playing a factor and you lose money. That's what I would say. Because 9 times out of 10, if your stock has risen the past 2 months, so you bought in January and it's now at $9 by the time of the first week of March, 9 times out of 10, a stock doesn't just keep going up, 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 up. Eventually you're gonna have a little dip. It's natural. It's the natural order of things when you're looking at the stock market. Every company has it, from Amazon all the way down to Foot Locker. Everybody has, your ups and your downs throughout the year. So when you're playing with time decay, and let's say you reach one of those down times, now you're losing a lot of money, and you could have got out of it when it was rising. So you definitely want to get out of a stock when it's rising versus getting out of it when you're going down your cliff, because now you're losing money, and time decay can play a big factor with that. Another thing when you're buying contracts, you definitely want to look at your price. I would say buy a contract anywhere from, you can buy one for $5. Usually the cheaper the contract, the riskier it is, and the probability of it reaching that strike price is a lot less versus buying in the money. And when I refer to buying in the money, I buy the stock X is worth $4 today, right? I'm saying by March is going to be my strike price is $3. I've now bought in the money, but my contract is going to be a lot more versus if I bought that contract set to expire in March and the strike price is $8, because I'm buying out of the money. And another thing, when you're trading options, you have two options when it comes to that. You can buy a call, which is saying that you feel that the stock is going to go up and it's going to rise to your strike price, or you can buy a put. And what a put is you're saying that your stock is going to go down. The stock from stock X is going to go from $4, and then you're buying a put, and it's set it to expire in March, and you're saying it's going to go down to $2. So that's what a put is. You're saying that the price of the stock is going to go down, and then you're betting on that. And it has the same rules as if you're buying a call. The closer that you get to your expiration date, time decay plays a big factor in that. All the rules are the same. The only difference between the two is, like I said, a call, you're buying, you're saying that the stock is going to go up. A put, you're saying the stock is going to go down. It's one and the other. And like I said, you can play that how you will. I like both personally. I'm more of a call person though, because I like to bet on the stock going up. I find it a lot easier to bet on the stock going up versus betting on the stock going down. But like I said, I've also made good money on buying puts, because sometimes when you look at the market, you can tell, okay, this is going to go down. So for instance, for a lot of people that's new to the market, oil is a big thing in 2020. Just with the coronavirus being out, a lot of people not traveling, a lot of people not flying, things like that, oil dropped, right? So when you're looking at that, oil demand and things like that, oil prices decayed over time, and now the price is down. That's one of the main things that you want to look at. And I would say definitely do your research when you're looking at stocks. Look into the market, look for stocks that you know is going to dip and you know it's going to go up. That way you can actually buy a call or put in those, and okay, it's going to go down. This is something that's going to drop. So I want to buy a put in it. I want to buy a put in an oil company, because I know 9 times out of 10, 6 months from now, oil is going to go down a little bit more. That's the thing that you want to focus on when you're buying options and things like that. Another cool thing about buying options is the accessibility of them. And the thing is, when I say when you're buying contracts, you're looking at your strike price. For me, I like to buy anywhere between $1 a head or anywhere between, $5 a head. So stock X is worth $4. I'm buying my strike price for either, anywhere between $5 to $9. And if I'm doing that, like I said, I want to at least give it 2 to 3 months, because you have to look at the research on your stock. So if I'm buying this stock and I look back a year. You at least go back a year. I would advise go back 2 years on that stock around the same time frame that you're looking at your option expiring. So if I'm looking at from January to March, my contract expires in March. I want to go back to 2020 or 2019 and look, what did that stock do between January and March? Was it going up? Was it going down? What was happening? Is this like a common trend? Things like that. Try to find your common trends. And from there, if it's going up and you see it as rising, okay, this is something that's a trend. It usually rises around this time. They usually release good reports. They release earnings around this time. So this is something I want to buy a call in. Or this is something that's going down, and they usually, fall in during this time just because this is not their, busy season, or this is not something that they're going to be making a lot. So I want to buy a put in that because I feel this is, history tells me they usually drop around this time. So then now I want to buy that put option in there because that's something that you want to look at. You want to look at your past time that a lot of people don't do. Go back on that stock, look a year back, look 2 years back. Do your research on it. Look what they do. Look at their trends because every stock has a trend. Doesn't matter the stock. Every stock has a trend. And then I would say with the exception of last year, just because, like I said, with the virus being out, stock market took a crash. Around March, if you look at it, almost every, major stock dropped. It dropped significantly. But I would say is that was a big buying opportunity. So do your research on it. Do your research and learn about whatever stock you're investing in, and do a big, dive into, okay, I went back a year. I see that this stock has been jumping a lot from January to March. But what happened? Did they release something? Did they have a certain product come out? Did they get a certain patent that they only have exclusive right to? What happened? Because that could be major. Just because last year it jumped between January and March, they could have just released a certain patent, or they could have got exclusive rights to some product that is not used. That's why they're not used to doing. So that's why I say go back 2 years. Go back 2 years, look at the research, do your whole DD on that stock, and learn more about it before you go into investing your money into it. But to get back on option trading, that's the things that you have to focus on. Option trading is a real good tool, a real quick bang for your buck when you're doing things. It's definitely an exciting thing to do because, like I said, you can make a lot of money option trading very, very fast because you can buy a lot of those shares versus buying them outright. A lot of people can't go and afford 100 shares of Amazon, but they can afford a contract in Amazon. So when you're looking at that and you want to get into that stock, you really want to get into Amazon, but okay, I can't afford Amazon. I can't afford, X amount of shares, but I can buy an option and I can buy a contract in Amazon. That's your access to that stock. Whenever you're looking at things that is just way out of the atmosphere that you're looking at, and you're like, okay, that's a stock that I just can't afford outright. Start looking at options in that stock. Can you afford some options? Can you, invest in those and get a good price to where you're looking at? So it all depends on, earlier I said between $1 to $5. That, on your strike price, that depends on your stock. When I'm looking at a stock like Amazon, I'm not looking between $1 and $5 because Amazon is not jumping $1 or $5. It's jumping more like $100 or $200, or it's dropping $100 or $200. 9 out of 10, the bigger the stock, the bigger it's going to go up, the bigger it's going to fall. It's just they have more room to wiggle, right? With $1,000 stock, you can lose $1,000 versus $1 stock, you only have $1 that you can go down. So look into that when you're buying options. You can definitely buy options in dollar stocks. You can buy options in $100 stocks. You can buy options in $1,000 stocks. There's every single stock out there, you can look into buying options in. So that's what you want to do when you're buying options. I would say your $1 stocks, they are cheaper, but they're harder to play with because 9 times out of 10, $1 stock, if you look at the history on it, isn't jumping $3 or $4 in 2 months. It's jumping more, maybe 10 or 20 cents. On history, unless, like I said, they're releasing some PR or some news that's making that stock move significantly. So that's one of the things that you want to focus on when you're buying options and trading options. But like I said, options is very cool. It's very something that you can make good money on quickly, fast. And if you're doing your research on it and doing your timing right, you definitely could do a good thing. And I know a lot of people that just only trade options. They don't want to, buy stock outright just because they feel, hey, why would I pay, full price, full retail, I should say, for that stock when I can go and get it at a discounted price and I can own 100 shares of that. I understand that 100% because me myself, I trade options myself, but I also trade regular stock just because I like that I don't have an expiration date. And that's another thing. Like I said, time is big when it comes to stock option trading. You have your time decay and you have your expiration dates and you have your timing of when you're getting in and when you're getting out of that. Because like I said, 1 month, you buy 2 months out. February comes and you're up and your stock is rising, and in the first week of March it drops. Your contract drops. So it's all about timing when it comes to that. And like I said before, you want to buy a contract at least 2 months out. Now you can, if you've done your research and you feel confident about your stock and hey, they're releasing some news. Let's say it's some medicine stock out here, and they're about to get an FDA approval on some medicine that they're creating. Then by all means, you can buy that contract within 2 weeks setting it to expire, or a month set to expire, and go from there. But like I said, time decay is major. And the more you start trading options, you'll learn that time decay plays a big role in how you're going to start buying your stocks, because you want to give your stock time. That's the thing. You want to give it time to go up or go down. And when you don't give it time, then you're literally looking for something quick, and you're needed to jump, because if it doesn't, then time decay is going to eat away at that price. If it stays solid and the stock never changes, so we bought stock X at $4 and it's still at $4.25 at the first week of March, now time decay is kicking in, and now we're not getting anywhere. So definitely look at that. Look at everything before you actually buy that contract. But like I said, the thing about option trading is you buy a contract, and one contract is 100 shares of whatever stock you're buying. You own more. And like I said, try to buy at least 10 contracts, because if you do the math, 10 times 100, that's 1,000, right? So now you own 1,000 shares. If that stock jumps $1, now you made $1,000. That's even when you're buying stocks outright. Try to buy a stock and do your research on the stock that you can afford at least 1,000 shares of it. That way, when the stock jumps $1, you now made $1,000. And that's so on and so on. I've looked at even penny stocks, right? So when I'm referring to with penny stocks, anything under $1. There's stocks out here that's worth 80 cents or 50 cents. You can invest, say you buy 10,000, right? $5,000 right there. You buy 10,000 shares of 50 cents, $5,000 right there that you spent. But now that stock jumps $1, you now make $10,000 because you own 10,000 shares. So that's the other thing. When you're looking at the stock market, the more shares you own, the more money you can make. So when people would say, hey, I want to go buy options, I want to get contracts and things, what they're really saying is I want to own a lot of shares so I can make more money. Because if I go buy that stock outright, I can only buy 50 to 20. And as some of you have seen that's new to the market, if you own one share in something, right? You own one share in stock X and it's worth $4 and it jumps $50, you've only made $50, right? That's good. That's a positive. That's a profit. But just imagine if you own 10 of them. Just imagine if you own 100 of them. You would have made 100 times $50. So the more shares that you can buy in a stock, the better it is. And that's why people also look into option trading, because you own an abundance of shares. And that's the cool thing about it. So a lot of people ask me, okay, so when you buy this contract, do you ever wait until the last day? Of course. Of course, when I'm down on a stock, let's say if I bought stock X at $4, it's set to expire in the middle week of March. The first week of March is down to $2, right? Now my contract, I bought it for $23 back in January. Now we're in March and it's worth $0. For me, I look at it as no point for you to now trade it because you're not making nothing. You now have lost $23. So you might as well sit on it, because things happen. Stocks, they get news, PR comes out, it jumps up, and now that it jumps back up, now you can potentially get out of it and at least make something or make some of your money back. That's the only time that I really hold a contract until the expiration date. Other than that, like I said, I'm out of it at least a week or two before the expiration date. You really just don't want to play with holding that contract until the expiration date because of time decay. Time decay, like I said before, is the thing that you have to worry about when it comes to buying contracts because it can eat away at your contract like no tomorrow. So that's something that you definitely want to look at. Another thing when it comes to that, look at the stocks that are very volatile. Any stock that is volatile, that goes, when I mean by volatile, of course, it goes up or down a lot, constantly. Every other week is up or down, up or down. Um, those are the stocks that's really good to trade option in when you're looking at calls and puts. The reason why I say that is now they are risky, right? They're riskier because they're jumping up and down. But the thing is, those are the stocks that's going to make you your money. Those are the stocks that you're going to go from buying a $25 contract, and now that contract is worth $1,000 because it's jumped $10 over its price, right? So you bought the strike price at $8, now it's worth $18. So 10 times 100, now it's worth $1,000. That contract went from $23 to $1,000. So that's something that you want to look at when you're buying those things. Like I said, I love option trading. I love buying contracts and things because I can get an abundance of shares. That's it. And I'm really only buying, don't get me wrong, sometimes I buy contract in stocks that's, cheaper stocks, $10, $20 stocks. I might look into buying a contract in those, but 9 times out of 10, if I'm buying a contract, it's in something that's, 4 or 5, Boeing.